Dear friends, a very warm welcome to all of you. My name is JP Sinha. Today I want to discuss with you the theory and practices of personal finance. This is going to be a series of 4 sessions. The first one begins with knowing yourself better. In this session, I'll be discussing about how do you get glued to the basics. In our investment journey, we often digress, while our intention is not to. But yes, we often. And believe me, once you digress, it becomes very tough and painful to come back on track. So let us begin our journey. I hope you will enjoy it. Journey of personal finance starts with you. One has to know his or her personal financial situation. Hence the topic is named Start with Knowing Yourself. This is the first part of our 4 sessions. Let us look at the following questions. You may find them familiar. It's not an exhaustive list, and some of your questions may not be part of it. But nevertheless, these are real life questions. More often than not, you are nagged by these questions. Take, for example, the second one. Are my investments in right products or instruments? Even if they are, you will always have doubt, either earning too little from it or having too much of risk giving you sleepless nights. So, what is the answer? Let me address these questions by taking a step back and let us understand the different colors and size of our financial needs. For ease, I have separated them in 3 buckets: our daily needs, mid-term needs, and long-term needs. First one is our daily needs, the ones which we need in our day-to-day life. It is very difficult to cut cost on these items. Our monthly regular income takes care of these needs. Second one is our midterm needs. These needs are those which we can foresee and broadly know both its timeline as well as size. For example, your child's higher education or marriage, upgrading to a luxury car, or making down payments for your dream home. To address these life events, we keep aside some money regularly so that we don't have to borrow or altogether kill our dreams. Third one is our real long-term needs or goals. During our early part of career, these goals looks futile or say meaningless. No one thinks about retirement. It hits when we cross 40 or 45. That is when the countdown begins. Incidentally, if you are not too successful, this is also the time of midlife crisis when you feel that others are ahead in race and you are getting nowhere. However, you would be surprised to know most likely that grass is not green on the other side too. A happy, independent, and worry free retirement is a big overhang on one's mind. And we start calculating our kitty and whether it is sufficient. A major chunk would also go into medical and health related expenses. Thanks to our insurance companies, they will take away your umbrella when you need it most. I must congratulate you if you are not too worried about your retirement. In case of our long term goals, we broadly know the time, but we rarely know the size. And believe me, this is what needs maximum discipline. Thankfully, government mandated PF and pension contributions take care of a large extent. But for many, this may not be always available. For example, self employed professionals, traders, other business community people. It is therefore very important to save and invest regularly to build your retirement kitty. So the question is, how should we build our portfolio which can take care of our needs? To understand this, let us look at this simple arithmetic. Let us assume we earn 100 rupees and spend 70 rupees on our monthly needs. We are now left with 30, part of which we are saving in PF, PPF, NPS, other paying EMIs, right? Now the kitty available for your discretionary saving is say rupees 20. Now all the rigmarole is now about what should I do with this money? Where should I save or invest so that A, it is safe, and B, it gives me good return. Let me add here, while good return is only relative, what you look for is, will it help me build my kitty sizable enough to meet my needs which may be known or unknown. And believe me, you are spoiled for choices depending on how many calls you get from advisors, insurance agents, banks, stockbrokers, etc. etc. It's quite visible. If you have less expenses, you will have more savings at your disposal, which will help build your corpus bigger. Happy situation, right? Not always. So let us find out which bucket you fit in. For your simplicity, I have created 6 buckets. As said earlier, less expenses means more money at your disposal. Likewise, if you spend more than what you earn, you are left with very unhappy situation of borrowing to meet both ends. I mean, forget about saving. Now here you should pause your video for a moment and reflect upon this quite innocuous looking slide. There will be a few people on either extreme buckets, a typical bell curve situation. Now, if you belong to A, I am sure you are in the nirvana mode. This is possible in only 2 cases. Either you are very rich or you are very content. In either case, community definitely needs your knowledge. However, as far as investment is concerned, I can only add your focus should be towards protecting your wealth, which in itself is a big task at your level. If you belong to B, you are closer to nirvana. You are the real inspiration for others. While your finances are in control, you need to invest and protect your wealth wisely. Likewise, on the extreme end, those who are part of bucket E need a serious consideration at their expenses or additional or changed ways to increase income. However, both easier said than done. This class is the most fluid one. Wise ones will move up into D, but there are others who are vulnerable and may get into the trap of F. If you are accidentally into F due to job loss, then the worry is less. Otherwise, it needs serious change in job or behavior or counseling to move up the value chain. Let us now focus at C and D. You would observe that majority of the working class falls under C and D. This is the big bulge of bell curve, and hence I would add an easy target for all the financial marketeers. If you are in either C or D, your challenges are way too many. You not only need to save wisely but also invest wisely and protect it wisely. You are spoiled for investment choices, and in many cases, listen it carefully, in many cases you are investing with the crowd without knowing if it is right for you. Take a pause. I am sure you know the following categories of products available to you along with the risks which are attached to it. While many of us know the various risks attached with different asset classes, what we may not know is one, quantification of such risk, two, the degree of such risk which varies due to the different combinations of various asset classes, three, suitability of risk, how it is good or bad for me, and fourth, the mitigation of risk. If you are investing without knowing all these four answers, probably you are trusting your luck more than what you should. So, knowing yourself is an incomplete without knowing your risk profile. The term risk appetite or risk profile means what is the level of risk, financial risk, you can take in the market. A good advisor is expected to know your risk profile, risk appetite, and suggest or offer you the products which fits into your profile. You should know that there are 3 things which defines your risk appetite. 1, your ability to take risk. 2, your need to take risk. And 3, your willingness to take risk. Well, I have found advisors which club ability and willingness together, but in my humble opinion, they should be kept separate. Say, for example, I may have the ability but not the willingness, or vice versa, I may have the willingness but not the ability. It is important to note here that there is no right or wrong risk profile or risk appetite. I mean, the risk itself undergoes change over a period of time or when my financial situation changes. Now, if you don't know, I'll give you a quick questionnaire so that you can check what is your risk profile. Let me add a caveat here that this questionnaire is only for illustration. Your advisor should have a more comprehensive tool to ascertain your profile. Nonetheless, this will give you a good idea to begin with. I would suggest you to pause your video here for a moment and check your own responses. there are 9 questions and your score can vary anywhere between 8 to 45. Broadly speaking, if your score is above 35, you can withstand higher financial risk. Your risk is moderate, or rather your risk appetite is moderate if your score is between 15 and 35, and if it is below 15, your risk appetite is low. Now, as mentioned earlier, you should select financial products which commensurate with your own risk appetite. Let me add here that selecting products having lower risk than your own risk appetite may have a slight adverse impact on your portfolio, but selecting products with higher risk than what it is suggested will have serious repercussions not only to your investments, but it will come with own set of other problems, and this should be clearly avoided, right? So now the question is how to build my portfolio. So if you have noticed till now, we have focused on 3 items. One is your needs goals, 2 your own risk appetite, and 3 the products that you should select. Now, building a portfolio is balancing this trinity of risk appetite, your own goals and needs, and the products which are available in the market. Now, once you know these moving parts well, it is easy. But let me also remind you that there will be multiple combinations and the whole spectrum can be really large. Now, finding your own unique combination is the key for happy investing. With this, we complete the first topic of understanding yourself and your financials. As practice, you should first identify your own numbers, check, recheck, verify, modify. Do it at least twice, and also make sure that it corroborates with your past behavior. Doing this will help you know yourself better. However, as a caution, I would remind you, please do not trust your memory or gut feeling, but check with the facts. Now we come to the end of this session. In the next session, we'll be talking about the asset allocation. You must know that the asset allocation is the single biggest factor which determines your return of the portfolio. So, we'll be discussing asset allocation in our next session. Till then, stay safe, stay blessed, and thank you. If you want to be notified, please click on the subscribe button.